Talk Media Limited, where complex ideas are explained clearly. Hi, I'm TaxMax. Let's break down today's tax topic.
Fact: corporation tax is paid by UK companies on their profits. When a business changes hands, it usually happens in one of two ways. Either the shareholders sell the shares in the company, or the company sells its trade and assets. This episode focuses on a share sale, where ownership of the company changes, but the company itself continues to exist as the same legal entity. In a share sale, the buyer acquires the company with its entire history. That includes all assets and liabilities, contracts and employees, accounting records, and crucially, historic tax positions. Any unpaid tax, unresolved HMRC inquiries, or aggressive tax planning remains inside the company after completion. Because tax history transfers with the company, buyers carry out tax due diligence. This process looks for underpaid corporation tax, VAT errors, PAYE and national insurance issues, unreported transactions, or uncertain tax positions. If risks are identified, they may be dealt with through price reductions, warranties, indemnities, or deal restructuring. Certain tax attributes stay with the company, including carried forward trading losses and capital allowance pools. However, anti-avoidance rules can restrict their future use following a change of ownership. Losses may be limited where there is a major change in the nature or conduct of the trade. To reduce risk, sellers sometimes restructure before sale. This can involve hiving the trade and assets into a new subsidiary and selling shares in that new company instead. Historic liabilities are left behind, giving the buyer a cleaner acquisition target. When a company sells shares in another company, any gain is normally subject to corporation tax. However, the substantial shareholding exemption, known as SSE, may apply. If SSE applies, the gain is exempt from corporation tax, but capital losses are not allowable. If SSE does not apply, tax charges may arise, and degrouping charges must be considered where assets were transferred within the group in the previous 6 years. Where SSE applies, certain degrouping charges for capital gains and corporate intangibles are switched off. However, charges relating to loan relationships and derivatives may still arise. This makes pre-sale group history particularly important for corporate sellers. The sale of shares is generally exempt from VAT. This means VAT incurred on professional fees is often irrecoverable. Transaction costs must also be reviewed to determine whether they are capital or revenue in nature, which affects deductibility for corporation tax. A share sale can change the number of associated companies in a group. This can affect corporation tax thresholds, rate bands, and relief availability. These effects often arise after completion and must be reviewed promptly. Where shares are sold by individuals, gains fall under capital gains tax. Reliefs and planning points may include business asset disposal relief, EIS deferral, earnouts, deferred consideration, loan notes, and share-for-share exchanges. The structure of consideration can significantly affect the tax outcome. From the buyer's perspective, issues include restrictions on loss utilization, deferred tax liabilities, stamp duty on shares typically at 0.5% of consideration, possible clawback of SDLT reliefs if control changes within 3 years, deductibility of interest and deal costs, and post-acquisition compliance obligations. In summary, a share sale transfers ownership, risk, and history. Understanding the tax implications on both sides is critical to pricing, negotiation, and post-completion outcomes. And this brings us back to the fact we opened with. Corporation tax exposure stays inside the company being sold. That is why historic corporation tax risk sits at the center of share sale negotiations. What's a tax lover's favorite dance? The deduction shuffle.
Educational content only, not advice. Rules can change. Thanks for watching. Clear explanations, one place, Talk Media.